Hello, and thank you for taking the time to watch this Financial Trading Mastery introduction video. The 60 minutes you're about to see have been taken from the new full 2-day program hosted by Vince Stanzione, which will be sent to you once you sign up for the Millionaire Trader program. You can find out more at www.millionaire-trader.com.
The way that I trade and invest isn't very, very time intensive. If you're spending longer than 20 minutes a day, 30 minutes a day, you're doing something wrong. And it's not, you see, the way I was brought up, and many of you were brought up, you go to work, you work from 9 o'clock till 6 o'clock or whatever. The more you work, the more you make. Yeah, we get paid by the hour. In this business, we don't get paid by the hour. In fact, in many cases, the more hours we spend, we actually lose more money. So if I walk in, do 20 minutes and walk out, and you spend 8 hours looking at the screen all day, you have technically worked harder, yeah? But it doesn't mean you're going to make money, whereas I just walked in and walked out, and I can make more. Some of you know about the turtle traders. If you read the Curtis Faith book, they talk about ping pong. Most of the time, they were playing table tennis. I heard this when I was in Indonesia. Somebody told me this. And I hadn't heard it before, and I thought, oh my gosh, we've got to include that in the seminar. Your needs are limited, your wants, well, they said are unlimited, but I've said may be unlimited. Do you understand the difference? What you actually need to be happy and maybe what you want are two different things. And here's another thing as well. It's like, when I was sort of making my money, I thought, one day I'll have a garage with 20 cars. Do I have a garage with 20 cars? No. But a funny story, I talk about a bad trade. This wasn't even, I bought some cars from somebody called Tom Hartley. By the way, I don't have a garage with 20 cars because when I got the money, I thought, why do I want a garage with 20 cars? It was just like something, you know, like you aspire to, but then the reality wasn't so exciting. 2009, Tom Hartley phones me up, says, Vin, I was in Mallorca, and he says, right, you've got money, buy a Ferrari Enzo. And I go, what do I want a Ferrari Enzo for? I'm living in Spain. He goes, I'll look after it. It's 450 grand. Do you know how much a Ferrari Enzo is now? It's a couple of million. And I thought, no. So, because what was happening during the crisis, people were selling their Ferraris because they needed cash. And obviously the market actually bottomed. By the way, Ferrari's been a very good stock for us. Yeah, did you see yesterday it hit a new high? RACE, R-A-C-E. Ferrari was spun out of Fiat. We bought the Fiat shares, and we got the Ferrari shares for free. And they've done pretty well. Fiat still owns the majority of Ferrari, but we'll talk about spin-offs either later or tomorrow. So smart minds often don't make money. And I'm not asking you to be stupid, because I know many of you here are educated, you're doctors, you're dentists, and all the rest of it. But when it comes to a little bit about what we do in the next few days, dumb down a little bit. It's actually better to be a little bit more simple than it is to be more educated. And you don't need to learn all the ins and outs. Unless you really want to beat yourself up, you don't need to know all the formulas. Okay? Because thank God the software does it for us these days. You don't have to calculate it by hand. And it's so true, sometimes they say if you've got more than 3 pieces of information, you tend to find it gets harder and harder to make a decision. It's like when you get a meeting and you get a big committee and you want everybody to decide. It's like the more people in the room, the harder it's going to be for them to decide. But normally they find that if you get more than 3 pieces of relevant information, the decision making actually goes down. It doesn't get better. Now, this is interesting because we had this front cover of Bloomberg Markets in 2015, and lo and behold, Jim Mellon and his brand new book, which you'll be talking about tomorrow. Unfortunately, it's a little bit delayed, but you've all got a copy because I've bought everybody a copy, including the guys at home. You'll get this in your home study course as well, but it's not going to be ready tomorrow. But he'll be talking about it. And this was a front cover, and it blew me away. And Google was basically talking about that, you know, you could live forever, or they were talking about 500 years. Jim's going to be talking about living to 130. And you know, a lot of the companies we're investing in, and we'll talk about them tomorrow, is the chances of us living a lot longer than you thought you would is very, very real. It's very, very now. Because when I first started out in 1985, we were taught that once a guy gets to about 65, he retires, gets his pension, and then what's going to happen in the next few years? go and play golf, he should die. God forbid he lives till over 70. But now we've got people living till 80 and 90. I've got quite a few British Airways pilots, the old school British Airways pilots, and they're still on final pension salaries. So they're still okay. And they're now, because they retired, a lot of them retired at 55, fairly young, and British Airways is still having to pay them out. Of course, they scrapped all that. All the new pilots don't get that because they can't afford to do it. Now, a couple of years ago, because you see sometimes I'll do releases, if you search Dow 14,000, oil $50, you see my name comes up. I do a few things like this just to stay relevant and keep me in the press. And I did a headline, if you don't want to eat dog food, you better start making smart investments. And that was in 2013. And it was true because what I saw, many people, especially when they got to like 60, they thought, oh, I better play it safe. But if you're going to live until 80, 90, 100, you can think 10, 20 years ahead, yeah? But in my days, we were always taught, when somebody was 65, oh, you've got to go into safe investments. So that's the whole point there. This is an actuary's list, and as soon as everyone sees it, they look for their age. It's a guide, it's not a guarantee. You know, God forbid you might get run over by a bus, whatever. But if you can live to this age now, this is the likelihood what you're going to live to. But I think this might be even on the low side. So the Queen's going to have to start writing a lot of 100-year-old telegrams out. She'll probably send you an email or a text. So 90 is going to be fairly normal. And you've got to start thinking about this, because if you're investing or you're saving money and thinking that my life isn't going to be, you know, I'm going to die at 75, 80, and that's a horrible thing, but you've got to think about it. But I'm giving you the good news. The good news is it's very likely we're going to live longer, and what Jim calls like welderly. The problem is, of course, a lot of people are not going to have a very nice retirement because they've got no money. Now, of course, this is also a very, very big investment theme, yeah? So the next day or two, we're going to be talking a lot about this, because biotech, pharmaceuticals, anything to do with the aging market, I'm interested in. Now, if you haven't looked around you, our demographics of people that are learning to invest and trade with me, my typical client is around 50. Which is still young, it's not old, but it's not 20-year-old kids. I do get some younger traders, investors, but on the whole, it's about 50 is my average age group. Now, some of you know about the baby boomers. It's all to do with the World War II, where more babies. They will peak around 2030. And in the US, there's around 7,000 to 10,000 baby boomers retiring every day. So this comes from JP Morgan. And it's the probabilities of your life expectancy. If you're in a couple, at least one will live to a certain age. Then if we look at the other side, again, you've got this in your workbook so it's clearer, how much your shortfall is, yeah? How much, you know, you're actually going to come up short to keep some sort of, you know, lifestyle. Because what's going to happen is your medical costs are going to go up. Yeah, people say, oh, well, I'm not going to spend as much money when I retire. I think you will. And your medical costs are going to go up as well. But start thinking in your head what your retirement age is and how long you're going to live. And especially when you hear from Jim tomorrow, it's great. I think it's amazing. But at the same time, for some people, you've got your ages skewed. Purchasing power. I know I joked and I said when 2 million was worth something in 2003. 2 million today isn't worth the same it was 14, 15 years ago. Yeah? If you had £50,000 today, you need around 175,000 in 30 years to get the same purchasing power. If you've got $500,000, well, you've all got $1 million now, but if you had $500,000 and you just left the cash under the mattress, in 30 years, the purchasing power, do you understand, is going to be a lot less. And what's going on, even when people say, oh yeah, it still costs £1, they've made the packet smaller. Yeah? What used to be 500 grams is 375 grams. You heard about the Toblerone being spaced out? Yeah, because to give you less chocolate. It's nothing to do with your health. They don't care about, you know, calories and stuff. It's because it costs. It's a way to bring costs down that you don't see it. And I believe inflation is starting to move again, which is why you may find in the next year or two, we start going back into commodities again. So stay tuned. So what's better? $1 million today or 1 cent today and doubled for the next 30 days? Most people will take the million, yeah? They'll say, all right, give me the million now. but you've just changed yourself by 4 million. You say, what? And the amount of people you show this to, and they say, that's not right. And this was on Bloomberg. 1, 2, 3, 4, the 5th day, you see how we're going up? Which some of you know, some of you old geekies will remember the memory. Do you remember why memory was in 128, 256, 512? Because the memory used to double. So, how did I make 2 million with IG back in 2003? And I'm going to show you my business plan. And when you see it, you're going to laugh. And although I wasn't doing this deliberately, and I'll tell you a little bit about it because we've still got a bit of time just before break. So this was The Guardian, which was the big article that I think a lot of you saw back in 2003, still online. That was me with Stacey, Ash. Back in the days, I used to go and pick up the checks from IG. And then I took that 2 million and made it into over $20 million, and obviously a little bit more as well. So the boring secret how I became a multimillionaire. My income went up, but my spending stayed fairly static. I put the money out of reach, which in turn made more money, and then you get richer. Had I just spent everything, so during that year with IG, it was commodities mainly that I was trading, and I wasn't very smart because had I used a futures broker, somebody like Man or Refco at the time, I would have made a lot more money. But you know what? It worked. It was still good because they made a lot of money out of that series. Anyway, it was the simple. And even now, although not as aggressive, it was the pure compounding. So it was one trade was closing out, another trade was opening up, another trade, another trade. Now, since then, I've had clients go on and make $1 million, $2 million. The biggest compounding trade lately has been Amazon, which is the one that I've heard, because I obviously get a lot of feedback. There's people that made over $1 million in Amazon in the last 2 years, starting with about 50 grand. 50 grand 2 years ago is about, you can do, because Amazon is nearly 1,000 a share, and they've got 1,000 shares. So they've got 1 million, and they started with 50, just by using this simple technique. Then I had a guy who did it very well in currencies. So it doesn't matter what market you're doing it, but it's the same principle. It's just going from one trade to another, and it's compounding up. Of course, it's not a straight line. You know, everybody thinks that, oh yeah, it will all be a straight line like the mathematics show. There's lots of ups and downs in there, but predominantly, you know, that they were moving up, they were compounding. And again, this is another great little slide. It's like people come here and they think, oh yeah, I just rocked up this morning and I just put my laptop and, you know, yeah. You saw this, but you didn't see everything else. You know, I love it when I was talking to Chris about in the interview, we were talking about people that think they can start a restaurant. Just because you know you can go and eat in a restaurant, it doesn't mean you can start one. And it's the same sort of thing where people just think that, oh, you just rack up. You know, there's a lot of dedication, there's a lot of hard work, there's good habits, there's sacrifice along the way. But the main thing is to say why I accumulated that wealth and why I did quite well. One, I pretty much stuck to a plan. And two, I didn't keep taking it out. Had I kept taking the harvest, had I kept spending all my bananas like the monkeys did, then it would have never grown. Imagine, every time, let's say, the IG account hit 100,000, if I just kept taking the 100,000 out and spending it, it would have never compounded. Whereas by leaving it in and letting it compound, and of course taking some money along the way as well, but that's how this, you know, it built up.
I think Vince's course works as really well because he simplifies everything. Very, very easy to understand. And if you're a novice to this, you need sort of baby steps to take you along because it can be quite a nervous thing placing your first trades. I'm not a novice, and I've known Vince since around about 2002, and you can't go wrong with Vince's system either.
Our first guest today, I'm really proud to have here, is Chris Chillingworth. Now, you've got to love the internet. The internet actually, when Chris started becoming successful and he started blogging, said I was Chris Chillingworth, and it was a front. I was also Rachel, I was all these other people. As you can see, Chris is a real person. Unless we've amazingly morphed, we are different, you know, we are different people. Chris will tell you a little bit about his background, but he was sitting where you are sitting now. probably not even in such a great position. He first got the course, it was about 2010. Like most, probably didn't do much with it. Then he hated his job, then he started doing something, and now, well, he'll tell you basically this is what he does full time. As well as trading, he runs a really nice Facebook group, which is very, very positive, and he's basically gone on to do some great things. What Chris has also done, he's taken my systems and adapted them and added his own. And I really encourage that. You know, a lot of people say, oh, I want to do shorter term trading. Fine. Do it if it suits you and you want to do it, because you can take what I've done and adapt it. It's a bit like a recipe. You know, I can give you the recipe and that's fine, but if you want to make your little tweaks, if you want to change the time frame, then you can.
That's me. I've been trading financial markets now for 6 years. First 2 years I didn't make any money, I lost money, and then something clicked, which I'll go through in a moment, and I've been profitable now for the past 4 years, and so far this year I'm up about 39%. So looking hopefully at being profitable again this year. 2010, my son was born. I was working as a fraud investigator for an insurance company, which I hated that job. Very interesting. Everyone goes, oh, that must be really interesting to be a fraud investigator, but it is, but investigating people who you think have been fraudulent isn't a very thankful job, pretty much making everybody miserable, including myself. So I also used to coach football for the FA. I used to coach for Reading Football Club. I was a level 2 coach at their Reading Football Club Academy. And I began trading from home because I wanted to change a career. I wanted to get out of what I was doing. I'd always been interested in trading, but always assumed maybe I'm not good enough to trade, I don't really know what I'm doing. I actually picked up Vince's course. That was the first insight for me that you didn't necessarily need to know everything about the financial markets to be able to make money from the financial markets. And that it was my first introduction to trend trading and to systematic mechanical approaches to the markets. And that clicked for me, it made sense for me. It was my entry to being able to trade. So I'm going to talk about some of the mistakes I've made, because I think they're great learning opportunities, but also more importantly, what I think you need to do instead to make money. So my first 2 years, I was the emotional trader. Okay, and we talk about emotions being the enemy of trading because they cause you to make bad decisions. And the way I kind of look at it is, if any of you have watched Star Trek before, I'm not a big Trekkie, but I understand the characters in there. You've got two polar opposite characters. You've got Spock, who's kind of logical, he's very unemotional, thinks like a computer. And then you've got McCoy. McCoy is, we're all gonna die, sort of mentality. And McCoy would make a rubbish trader, in my opinion, because he's so emotional. Whereas Spock would probably make a fantastic trader because he doesn't let emotions get in the way. So in my first 2 years, I was very much like McCoy. I held on to my losing trades. So if I had a trade that was going against me, I would probably pull my stop loss down to give it some more room or whatever it might be, whatever the reasoning behind it. But I would hold on to that losing trade because closing that losing trade sealed in that loss. It was a definite thing. Once I closed that losing trade, it was in. And the idea of keeping it open meant maybe it could turn around. It was that hope that maybe it might turn around. That was a really bad thing to do, and I've learnt that since. And I'll go into, obviously, in a moment, what I think you should do. And most of you probably know, but I also cut my winning trades, because every time a trade started doing really well, I would bank it. I would take that money, because I'd had a couple of losing trades prior to that, or perhaps I thought things weren't going so well, and so as soon as a trade started to look good, I would bank that money. I would take it before it went back to the broker. And that's fear. That was, again, hope is a psychological issue, fear is a psychological issue. And I was very, very fearful that I would lose some of that money, so I'd bank it too quickly. I would fail to pull the trigger. So if I had a run of, say, 4 or 5 losing trades, and a 6th signal came along, sometimes I wouldn't take that 6th signal because I was fearful that it was going to be another losing trade. And again, you know, what would often happen is that six trade would end up being the big profitable trade that I needed to pay off those 5 losing trades that I'd had previously. And by not taking that signal, you know, again, that's one of the reasons why I lost money in my first 2 years. So I'm going to go through some of my results. Crikey, that looks horrible. I hope you can see that. Yeah, this is what I mean by spreadsheets. People.
You've actually got these in your book as well. If you double check in your workbook at the back, I've given you printouts of this. And also you're going to get copies of everything that, obviously this is all being filmed as well, but I did print all this out in your workbook. It's in the back. And the guys who are doing it on the iPads, you've got it as well. Sorry, Chris.
Marvellous, thank you. So, yeah, this looks horrible, I know. But I love this stuff. I love data. Yeah, I'm rubbish with my accounts, so go figure, I don't understand that either. But I love trading, and I love back testing, I like looking through data, I like working out what works, what doesn't. And I think going through data is really important, especially back testing. Because if you've got a system, and I get so many clients who will say to me things like, I'm having trouble pulling the trigger, I'm having trouble executing a trade. And I say to them, have you back tested your system so that you know that your system's worked well in the past, you've got a positive expectancy going forward, and you've got the confidence that you need to trust in the fact that your system works. No, I haven't back tested it. What's the point? I just trade it. And I just think, that's your problem. Back testing is going to give you a lot of confidence in your system. In my experience, that's what I found. Is that going through data and knowing what it's produced in the past makes it so much easier to trade it going forward. If you know your system has regular runs of 5 or 6 losing trades, when you then start trading it live yourself, and you're on your 5th losing trade, you shrug it off. It's no biggie. We know this happens, and it's still profitable. So it also gives you an idea of the sort of winners you need to be able to be profitable, and it shows the importance of keeping your losses small. So this is a summary of, well, this is an entire comprehensive view, actually, of my July trading on the DAX. These are all my signals, ins and outs. Every single trade that I made in July on the DAX, and you'll see right at the bottom, I had 9 winning trades, 21 losing trades. So, pretty rubbish. But what you'll notice is, and this is something that I learned from Vince very early on, that my losing trades are all tiny. They're all small. Minus 67, minus 60, minus 150 quid, minus 67, 68, there's a £200 one there. But then you look at the winning trades, a couple of piddly ones there, but I had an £805 win there, 1,875, 463, right down the bottom there, just shy of 700. And as a result, I ended up profitable. I made £1,286 in that month. And that's despite having way more losing trades than winning trades. What this information shows you here is the balance I was using at the time, the risk percentage. So you can see all those are pretty much bang on 2.5%, give or take the odd bit. And my risk, so what that represented financially of my account. So how much was I risking on each trade against how much did I actually lose, or how much did I actually win. And this R column here, which you'll see second to last column, is a representation of the risk reward. So if you see like the top one here, 0.22 loss, or minus 0.2, that means that it's the equivalent of basically losing 20% of my maximum risk. I risked £309 in that trade. So if my stop loss had been hit, I would have lost £309. But I actually ended up only losing £67. Why was that? Because of my trade generated an exit signal. And so I exited it based on my signals, not on the fact that my stop loss is there. And I use very wide stops. So what I generally find is because I'm using wide stops and smaller bet sizes, I'm finding that my stops don't get hit that often. In fact, probably only about maybe 5% of the time, maybe even less than that. Most of the time I'm exiting based on my exit signal appearing and getting out of that trade.
This is also interesting. I shared this slide with you on Trader Markets when I was doing it because I think it blew me away. And it was a Schwab study, but there's lots of other studies as well. I hold around 100 trades at once. But when I say trades, they're investments. Some of them have been open for 15 years. I'm not checking them every minute, but roughly my figure is about 100 positions open. Now, if you're saying, well, my account can't afford to have 100 positions or whatever, this is where ETFs come. This is basically what the crux of it, and I've seen this in real life. Now, Chris is talking about trading one system on the DAX. That's fine. I'm talking more now about longer to medium term investing and diversification. If you have one or two stocks, the chances of you losing money is very, very high. So if we look at 5 stocks, for instance, the chances are you're going to lose 40%. The chance of you losing money is 40%. If you have 20 stocks, it comes down to 25. If you have 40, it comes down to 12. And as you start bringing up the number. Now, there's a point where you'll say, well, Vince, if you buy 500 stocks, you own the S&P 500. You're absolutely right. You might as well just buy the index. And there's a lot of fund managers which are called closet trackers. So what they say they're active, but they're not. They're just basically tracking the market. But what I want to get into your head is I've seen it with some new traders where they say, to start with, I only want 1 or 2 trades. That is so dangerous because you're putting all your eggs in one basket. Whereas having more trades or having an ETF gives you more diversification. So the reason why I haven't lost money in 18 years is, I've also gone short, but I have a diversified basket. If I was only in a small amount of stocks, I think I would have had some losing years. All right, so get out of your head about only having 2 or 3 trades. It's very easy to manage trades these days. It doesn't take long to manage trades. And also, I'm talking about things that you're going to be holding for the next 5, 10 years. Remember what we said earlier this morning, that you're going to be living longer. Everybody who's like thinking, I'm only thinking 2 years ahead, 3 years ahead, you've got to start thinking longer. So diversification basically brings down the risk.
I think his advice of diversification, of buying ETFs and of buying certain funds where you wouldn't necessarily go for one name, but you go for a basket. And actually his advice on the costs of a number of vehicles is invaluable.
So what do I believe? What do I know after doing this? 32 years coming up in September, 18 odd years of winning, is day-to-day markets may be random. All right. So on a day-to-day, if you ask me what the Dow's going to do today, I don't really know. And Chris is doing some shorter-term systems with exits and entries. That's great. I like the way actually that you made a lot of your money over a weekend, because there's this thing in some traders say, we don't hold positions over the weekend. Yet it's many times holding positions over a weekend is where you actually can make big, big money. But say 20 years back-to-back profits. It can't just be luck. There has to be something. So I've spent years developing my systems, and the big influences to me are, well, a couple of people. One is in this room. I was going to say everybody's dead, but they're not. Richard Donchian, he is dead. So he was the guy from Price Channels and which influenced the turtle traders. I don't use them as much now, but that was where I started getting into trend trading and price action rather than any news. David Harding, a name that some of you might not know, is Winton Capital. So there was a program called AHL, and I actually invested. He'd actually left before I'd invested, but there was a company called Man Group that owns the AHL program, and he was very mathematical based. He's still around, and Winton Capital is still around. You can actually Google Winton. Stock Traders Almanac, which is Jeff and Jeff's father. I first got my first copy of the Almanac in 1999, back in the old post days, and I remember getting this through, and it was like, oh, wow. So I started to put some of that into there. Jesse Livermore, Nick Davos, again, years ago, dead. Price behavior, psychology. So this is where a lot of my influences come from. I've given you the article. This is a really old article. A little bit about who Richard Donchian, or however you pronounce it, and obviously you know that these days most software has Donchian channels in there, and they were obviously the price, the 20-day high, the 20-day low. Of course, other days, other periods can be used, but he was like very much one of the early programmers or early people into price channels. And we're talking a long, long time ago. So if we look at a price channel on Philip Morris, so the classic Donchian is you buy at the 20-day high, breakout, boom, all the way up. When I first started using this, I used to do this by hand. So I used to get graph paper, I used to get keep the prices, use the closing price, and I used to count 20 days back, 20 trading days back, yeah? So wherever the 20-day low was, so count 20 days back, draw the line. Tomorrow, draw the line. Now, unless you really want to like crucify yourself, you don't have to do that anymore because most websites will have a price channel Donchian. This is obviously in ShareScope, all right? Now, I don't necessarily trade off this system anymore, buying 20-day breakouts, getting out 20-day lows. I'd like some of you maybe to take this and start developing something new with it. Of course, you could change the periods. You could be 20-minute period. It could be 20-second periods. There's all sorts of things that could change with this. But this isn't necessarily the trading system that I buy or sell. But this was one of the early influences, was price channels. Macaulay Culkin's birthday is the same as mine, by the way, 26th of August. Also Mother Teresa, but we've got nothing in common. Technical indicators are a bit like a religion. When I spoke to Martin Pring, we had Martin Pring over here many, many years ago, lovely guy, and he told me this. He says, you know, it's a bit like religion. If it works for you, fine. You know, everyone's not going to believe. So if you find that Fibonacci, RSI, Elliott Wave, Gann, Bollinger Bands is your magic bean, good luck to you. Have it. But I found, to me, and as I say, I'm now into sort of training these sort of systems at least 12, 13 years, if not 18 years, I found no value. And I wanted to believe, I wanted some of these things to work, but then more and more I looked at it, I thought, you know what, this is random. Because at the end of the day, then somebody could say, oh, well, the RSI gave a great buy signal on the 21st of October, 1998. Yeah, but it also gave 7 really bad signals before then. So you're being very selective. Anyway, so you're not going to hear any of that stuff from me because I just don't use it.
Sector rotation, another big part of our work. This is our tactical sector rotation calendar on page 92 of your Stock Trader's Almanac, if you have one. And you can see the cluster of bullish sectors here in October. We get a little action from oil in December, but we do have some short trades throughout the year. One of the ones that stands out that I'll highlight is the materials short and the materials long, very pronounced. So this is the basis of all of our trading throughout the year. We match up ETFs. We'll even go for stocks in these sectors at the seasonally opportune time with the setup that presents itself, not just because it's that season. Worst 6 months, top sectors, excuse me. The point of this is combination, not just what to look at to be invested in the worst 6 months, but not just the average gains, but the plurality of gains. So you see biotech up top here, right? 9.5% average. The median gains 2.3, so average gains kind of elusive, but it's only up 52% of the time. Not a huge amount of gains over that time frame. Whereas staples, solid 4.5% gain over 6 months, up 80% of the time. Utilities, up 73% of the time. The median gain is about 5%. And you can see bonds are pretty solid, up almost 70% of the time. Bonds going the inverse direction of stocks. So just an idea of the things that do well. And of course, at the bottom, you can see utilities, the worst performing sector in the worst 6 months. So let's look at materials here. Now, another one of these one-year seasonal pattern charts, pretty pronounced, follows the best 6 months rather closely. You can see from October through May, pretty bullish, down pretty significantly on average from May through October. And the proof, of course, is in the charts. So you can see, now this is similar to the best 6 months comparison, but it's not best versus worst. It's long the best and short the worst versus buy and hold. So 14.1% annualized gain and versus a 5.6% in buy and hold. The same $10,000 exercise starting in 1990 gives you a gain of $272,000 versus a gain of only $39,000 in just buy and hold. So you can see the juice that's added, the benefit of using the seasonal patterns.
All right, let's talk a little bit about financial spread betting. And it's interesting how people sometimes just miss the obvious. When I'm making an update on a stock, whether it be Amazon, Apple, IBM, or whatever, it's not a spread. It doesn't matter whether you're spread betting or buying the stock, okay? Because the way you make 2 million from spread betting is by getting the trade right. It's not the spread bet. The spread bet is just a tool. It's not, you don't make, there's no advantage of making money. Forget about the tax for a second. The spread bet is just a vehicle. So when people say, oh, you haven't talked about spread betting, I just take it that you can do it. You don't even have to ask me. So I'm going to talk about financial spread betting, contracts of difference, and then tomorrow we'll probably talk about binary depending on time. We've got about another 30 minutes. All right. First of all, what always gets on my nerves, people say that it was IG Index that started spread betting and Stuart Wheeler. No, it wasn't. It was actually Joe Correll, or Joseph, and I can't pronounce it in Polish, but let's say Kalasaki, who was an immigrant who came to the UK, and he was actually Joe Correll that was the first person to do spread bets in the UK, not IG. IG started in 97. IG, if you don't know, stands for Investor Gold. They only offered one market, price on gold to start off with. It mirrored something called bucket shops, which if you've read Reminisce Stock Trading, you'll know what bucket shops are. All right, so where do we make most of our money? Back to the racehorse and the workhorse. Well, we can make money in all markets, it's no word of a lie. But if you look at my accounts and look at where we've made our big money, it's been trending and quiet. That is where the big money has been made. It's been less volatile, caused us less risk. Now, even in trending and quiet these days, of course, we can get big pullbacks. But that's where we've made the majority of our money. And of course, you can make money on the short side. But as you know, if you short something, it can only go down to zero. Yeah? Obviously, if we go long something, it can go up 300, 400, 1,000%, which we've had in the past. But if we go short something, the worst it can come down is zero. So when I'm saying trending and quiet, of course, there's things that trend down as well. But on this particular, example, this is where we make our money, trending and quiet. Great example, British American Tobacco just recently bought Reynolds, which is another stock of mine. This is the US listing, if you're wondering why does that price look different. Obviously, it's listed in the UK, BTI. Domino's Pizza, another big trade for us. If you go back, by the way, when you go to trade on markets, you can always fact check me. If you look at the search box, put pizza in there, or Krispy Kreme donuts, or any word like that, it will show every time I've mentioned that word. Obviously, put Apple in, you'll come up quite a bit. But if you just put pizza in tradeonmarkets.com, if anyone's online now, you'll see where we bought Domino's Pizza. And again, that's been a great trend. Lockheed Martin, which is defense. And I wrote about this in my updates. When Trump came in, I said, look, I don't care who wins the next election. It's going to be good news for military. So this is an article which was in the Financial Sunday Express, which was 2013. And again, if you search this, it's online. And what I did, I went through my own trading and I looked at, would it better? I know it sounds horrible, but ethical investing funds on the whole don't do very well. They might have great ethics. Now, there's a Norwegian fund. So Norway has a lot of income from oil. But what they do with some of those profits, the Norges Bank or the Norwegian bank invests in other companies. If you search online and look for the list that they will not invest in, they're normally trades that you might want to have a look to do what? To invest in, right? Because Norway won't invest in tobacco, they won't invest in guns, they won't invest in arms, they won't invest in, a lot of unethical businesses. Now, I don't want to sound like I'm really terrible here and all the rest of it. It's up to you, it's your choice. If you don't invest in tobacco, that's your choice. And when I was with Bill Ackman, he basically said that. He said, look, as an investor, you have a choice of what you invest in. He personally doesn't invest in tobacco. What's interesting, one of his biggest trades is actually very sugar-based, so I don't know which one's worst. And we're going to be talking about that one tomorrow. and you're all going to get a sample as well, so that gets you hooked. But anyway, going back to the story, I basically did a study looking at my own account and other accounts. We made more money by being mean, being unethical than ethical. Okay, so the green investments. There was only one investment that actually came out quite good, and it's questionable whether this is ethical or not. Whole Foods Markets, which is like a pseudo health food, but if you look in there, they sell a load of stuff full of calories anyway. So it's questionable whether Whole Foods was ethical or not.
Vince is very approachable. He's so down to earth. You can get in touch with Vince normally at a moment's notice. You can ring him. He emails you straight back. Again, the system's so easy, and he's genuine. He's a great guy. There's just something unique about him.
Talking about currencies, this goes all the way back to 1971. It's interesting, when I first started in the currency market, it was down here, 1985. We were almost, we did spike down to almost parity, 105, and that was in September 1985. So this is the pound against the dollar, which many people in the trade call cable. If you didn't know why it's called cable, because that's the way they used to like transfer the prices between America and the UK by cable. When I first started trading, we used to use telex. And the young guy said, what's a telex machine? It's like I was just going to say like a fax machine, but you won't know what a fax machine is either. So it's like a printer, it's like a typewriter, and you type a message on it, and the typed message goes down a phone line and appears at the other end. And that's how trade used to be done on telex. So this is a long, long chart, basically. And the reason why I brought this up, because a lot of you here are still based in the pound or the euro. As you know, pound has pretty much like plummeted the last year or two against the dollar. But if we look at over the long, long period, it's not that unheard of. You know, we have seen these rates before. But if we draw a line all the way across, it's about 150, I think, is about there. So I think the fair value, because some people are starting to get really worried about the pound, is actually, I think, about 140, 150. So sometimes when I value my US investments back into pounds, I still use the 140 rate. Now, when I did this snapshot, we were trading at, what, 124. We've actually bounced off that. We're about the 128, call it 130. But the long, long rate for the currency is around 140.50. I don't know if we're ever going to go back to that too, but somewhere around there. So for some of you getting a bit worried about where the pound is, either whether the pound's going to appreciate or depreciate, a long, long-term average, and again, this is my view, it might be totally wrong, but the long, long sort of average has been about 140, 150. So if you base your exchange around that rate, I don't think you'll be too far off.
So today I'm going to talk about investment. I'm going to talk about my new book, which is called Juvenescence, and it'll be out on June the 29th. And I believe that Vince has kindly ordered everyone a copy of the book when it comes out. My sister's delighted because it's the first big pre-order we've had for the book. And then I'm going to summarize my thoughts and hopefully give you some ideas as to what you might want to think about investing in. So in terms of the market overview, as Vince said, I've just completed a 7,000-mile drive, not by plane, drive around the United States. And the purpose of it was, one, to have a look at the US and see, what sort of opportunities, what sort of feel one would get in the flyover country, as they call it, dismissively on the east and west coast. That's, the towns of New York, or the cities of New York, San Francisco, Los Angeles, and so forth, are well known to everyone here. But most of the inner part of the United States has not even been visited by many Americans. And so we did this huge, long tour around, and I must say that had I seen what I saw a year ago, I would have bet on Trump winning the presidency. And I bet most people here wouldn't have thought that Trump would win, and nor did I. But it would certainly have changed my mind, and I'd have had a different perspective on the United States. And the second thing I was doing on this tour was visiting what they call KOLs, which stands for Key Opinion Leaders, in the field of longevity and anti-aging. And as some of you know, every time I'm interested in a new idea, a new big idea as I call it, I write a book about it because it orders my own thoughts, gives me access to people who otherwise wouldn't see me, because being an author gives you access. Just being an investor or Joe Blow doesn't give you access to these people. And I met most of the key opinion leaders in the United States on longevity and aging on this trip. And I've tried to distill what their views are and what the opportunities are into this book, Juvenescence. And for me, it's a very hard ask because I'm not a scientist. So I spent the last 6 months really doing a self-taught PhD in longevity science, and probably made lots of mistakes along the way, but it's been absolutely fascinating. And I want to tell you that at the end of this presentation, I'm going to talk about that, because I do think we have a new big idea translating into the money fountain that will actually pay for our very long lives that are still to come. People in this room don't realize just how long we're going to live, but it's way, way ahead of the actuarial forecasts that are being made by insurance companies and others at the moment. And if you go onto one of these death clocks, and there are plenty of them on the internet, and put in your age and a few characteristics of yourself, such as do I smoke, how much do I drink, am I single, am I overweight, blah, 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 almost all of them will indicate that at whatever age you are, you're going to die at 82 or 83 years old. And that's wrong. Of course, some people will die younger than that, but increasingly less people will die below 82. But for sure, in my opinion, some of us in this room today will be dying at 120, 130, 140. And I'm going to try and explain why that is the case very briefly today, and obviously more fully in the book. And if that is the case, and I'm right, and these scientists who I've met are right, then we have to rethink the whole trajectory of our lives. And that's why, towards the end of this presentation, I'm going to very briefly summarize some of the points in that area. And so I wouldn't be short of China, but I watch it very carefully. And actually, we've now sold our positions in China. It's had a very, very good run. It was one of my recommendations, I think, 2 years ago here. And I would just be wary of China. If you want to invest in the emerging market, my favorite one would be to invest in Vietnam, which now has a reasonable stock market. There are some good funds out there you can invest in Vietnam. And it's more competitive than China. It's a much more dynamic economy. Its labor demographics are better, and I think it's relatively cheap compared to China. So look at Vietnam if you've got time. The other thing is that watch out for commodities. Right? You probably saw that iron ore has fallen sharply over the last couple of weeks. It's in oversupply. Most commodities are in oversupply. The only one that I like really of any significance is lithium, and I'll give you a recommendation on a lithium stock later on, because lithium is the key component for electric car batteries, and they are really taking off. And if you go to California, you'll see these Teslas everywhere, and I'm sure that electric cars will become the standard in the next 20 or 30 years. So lithium, which is in relatively short supply, is probably a good buy. My favorite area to invest is Japan. I think the Japanese stock market is cheap. It's about 14 times earnings. It's about half the PE ratio of the United States market. Japanese companies are beginning to improve their corporate governance. They have large amounts of cash flow. They're increasing their dividends. And Japan obviously has been benefiting from the weakness of the Japanese yen against the US dollar, because Japan is very export dependent, and those exporters are beginning to do very well. If you want, you can just buy the Nikkei, or you could buy Sony, which is my favorite Japanese big company. I think it's a very good company to buy. So Japan is my #1 tip for the next year in terms of a major market call. And I don't think the yen's going to depreciate much. It's around 112 against the US dollar at the moment, and I think it could go to 115, but it's not going to depreciate very much, so I wouldn't bother hedging the position. I would just be straight all out buying the Japanese stock market. And a good pairs trade is to short the S&P and to go long the Nikkei.
He's very genuine, and I like his approach of how he's going to deliver the course. He's very transparent. He's not going to hide anything. So this is a plus for me, and it gives me confidence to come and actually learn what he does.
So what do I mean by the butterfly effect, how it's affected us in the past? Who made money out of White Wave Foods here? Yeah? Quite a few of you made money. White Wave was part of a butterfly effect. What was White Wave part of? Before White Wave was spun off, it was part of a company called Dean Foods. When I was here in 2012, and I told you, look at this company, it's a milk company called Dean Foods. Everyone said, ah, milk, terrible business. But the plant extract business was really good. What happened to White Wave? White Wave got taken over by Danone last year, made us all a shed load of money. Had White Wave not been spun out of Dean Foods, Danone would have never bought Dean Foods. So how spin-off can basically start off a butterfly effect, how it can affect the CEO's job, how it can affect the whole, what we do. So I'm always looking for these sort of changes. They're definitely very, very interesting. But everything that Casper said, as I say, you know, the reason he's here is because I love what he does and I knew it'd be relevant to you. The other thing that's very, very important, whether you like it or not, your life has changed because of your, I'm not like saying it's all about me, but because of your interaction with me and these next 2 days. Even if you go out of here and you try and forget everything that Casper has told you, or I've told you, or Richard Wiseman. Do you remember the tuna song yesterday? 4 tuners, right? Try and forget that. You won't. So it's just things like that. It will affect you, and hopefully for the positive. But whether you like it or not, what you've learned and what in the last 2 days is going to make a huge, huge difference. And I think when you go back home, even looking and reading my work or the way you invest, this is all going to make a difference. All right, so let's carry on. My business, and Vicky kindly said in the introduction yesterday, I am very, very good at making difficult tasks very, very simple. The reason being, and truthfully, I'm not very academic, I'm not very smart, and that has done me very, very well and made me a multimillionaire. I think if I'd been smarter, there's a lot of opportunities I wouldn't have taken. As much as I would love to teach you how a mobile phone works and take my phone to pieces, and I know some of you want to do that, we don't need to. So my main focus is basically to show you how to use a mobile phone, rather than tell you, well, this is how it works, it's got a battery in the back, and this has got a chip, and it's got this chip here, and all the rest of it. So we're not going to take the phone to pieces, we're rather going to show you how to use it. So when we're talking about trading systems here, we're not going to go into every little bit. Also, remember what we said about the 80-20 rule, and Casper just mentioned it again. I don't care about 80%. All I care is about the 20% that gives us 80% of the result. Do you agree with me? Would you rather do that or do you want me to go through chip number 675? Yeah, so we're not going to go through that. I'm not going to teach you how to work out your own calculations on the video like Susan asked me to once. And I said, Susan, go and Google it. I don't even want to go into it. Because at the end of the day, ShareScope has already programmed it in. All right, so the market cycle, and again, this is who you believe, it depends. If we say there's a primary trend, which in my view, this is my life, this is what I talk about, 12 to 3 years. And it's interesting again what Casper was saying about instant gratification. The majority of people want instant gratification. They want the result today. Now, my correlation is that younger people want instant gratification. And if you look around the room, the majority of people here are, not saying older, because we're all going to live to 130, like Jim said, you are typically 45 to 50. Okay, that's not by an accident. Because that age group, in my view, has been better investors, better traders, because you know what? They don't need or want instant gratification. The 21, 22-year-old who racks up to me with £1,000 or £2,000 needs instant gratification. So that's the main reason why I shy away from younger students. Now, I have got some younger students. One of them is watching this in Sweden as we speak, who inherited quite a bit of money. And he's very, very responsible and a very smart guy. But on the whole, it's a slightly older bracket. The other reason why, let me tell you why I tend to do better with people who are 40 or 50 plus. When you're 20, everything seems like a big deal. Yeah? But as you get a little bit older, you've seen the movie before, and you tend to be more stable on the whole, and your reactions and your emotions, you know yourself better, you've seen a couple of market crashes like me, and you get to be, you get to deal with things better, whereas the younger crowd, they're just too up and down. Anyway, so primary trend is 12 months to 3 years. This is probably where I make the majority of my money. Now, before some of the people that say, oh my God, 12 months to 3 years, this isn't everything, but this is where I make the majority of my money in that sort of time frame. Also, please think back. The Spice Girls, I won't play it, Wannabe, was what year? Do you remember when the Spice Girls started? Roughly? 1996. Oh my God, a Spice Girls fan. 1996. Yeah? Yeah, if I play that now, a lot of you will still know the words. I know it's annoying, but that's the reason why they did well. Or you hear a song on the radio and you think, oh my God, and then you realize, I keep saying, oh, when we were here last year. We weren't here last year. We were here 2 years ago. And I can remember 2012 which is when we had Krispy Kreme donuts, which was taken over, by the way. Sometimes you know what they call 1 degree of separation, how one thing leads to another. If things years ago hadn't happened, I wouldn't have met Jim Mellon. If I hadn't met Jim Mellon wouldn't be speaking here and telling you about this. It's just amazing. Anyway, back to my point. 3 years, 5 years is going past quicker than you will think. This is what I would call the intermediate trend. This is 10 weeks to 12 months. We can make money in this sort of trend as well. And this squiggly line here is the shorter term trend, which is, for me, shorter term is 2 weeks to 10 weeks. Now, if you're in your life that you can't hold a trade for 2 to 10 weeks, then you're in the wrong room. Yeah? Because why can't you hold it for 2 to 10 weeks? Are you that instant gratification that you need to see a result? 2 to 10 weeks is nothing. Yeah? So that's, to me, my shorter term sort of time frame. So for me, as I say, if you cut me open, what am I? I'm a trend follower. I made my first million from trend following. The commodity money was made from trend following. And, you know, biotech was trend following. It's pretty much, a lot of it, what I do is following trends. Now the demographics that are going on, now again, looking at what Jim Mellon is talking about, it's a trend. So trend following is ideal for you guys who don't want to be watching a screen all day. You don't need expensive software. We can make money from a trend going up and down. What do you see? An old lady? Turn your head upside down or turn your workbook upside down. Now what do you see? The princess. So, how to turn an ugly trade around? You turn it upside down. It's a bit about Richard Wyman. Even now when you turn it back again, you still see the original, don't you? So don't be afraid to turn a trade around. It's a bit like being shot in the arm. Are you lucky or are you not lucky? Well, you're lucky because you're still alive. So if you got into a losing trade and you've lost money, and then you see the signal on the next trade, because now you're following it, you're almost lucky in that you're set up for the next trade. Okay, so don't be afraid to turn a trade around. Buying strength, selling weakness. Everybody likes a bargain. You know, we all like to buy something that's cheap. You know, when I first started in investing or trading, we all told buy low, sell high. But here's the truth. Most of the time, I've bought something that's already high and sold it even higher. Spin-offs and spin-outs. This is the butterfly effect. Give you an example. There was a company called Fortune Brands. Now, depends how long you've... Did anyone remember Fortune Brands? Okay. How we made money out of Fortune Brands. There was a guy called Bill Ackman that started that. He's an activist investor. Bill Ackman takes some shares in a company, quite a good shares, and then asks for a seat on the board or one of his members of staff on the board. Doing all right. Fortune Brands wasn't a bad company. It owned Callaway Golf. It owned Beam, which was the whiskey, and a few other, Jack Daniels, and taps. I was going to say faucets, as they say in America. Taps, kitchens, doors. Quite a bit of a mismatch of businesses. So what Bill Ackman says is, right, sell off the golf business, which they did, and he asked for a spin-off, butterfly effect, the ripple. So then, Fortune Brands Home Security becomes one stock, Beam becomes another stock, and as shareholders, we get shares in both. What happens to Beam a couple of years later? Gets bought out by Suntory, which is a Japanese drinks company. There is no way Suntory would have taken over Fortune Brands had it not been for the butterfly effect of Bill Ackman starting off and splitting. So again, I alluded to this earlier. This made me $240,000 in 4 years with zero risk. And this just paid out last year, as you know. So what happened? Dean Foods. We bought Dean Foods. Dean Foods is a milk business, very, very bad business because it's very low margin, can't make a lot of money in milk. But they own something called White Wave. White Wave is Alpro, soya, almond milk. You know, all of a sudden now everyone's got milk allergies and what have you. Great. Now, as you probably know, a carton of soya milk and a carton of almond milk and all these other products costs a lot more money than just normal dairy milk, and it's got higher margins. So here are the exact what happened. We sold our Dean Foods for more than we purchased them for. okay? I haven't even included. I was then left with 4,334 shares in Whitewave, okay? Danon, last year, and you can check all this, everything I say you can fact check, yeah? That's the thing about me. All my sales letters are all absolutely true. You know, some of you have been asked if you could give a few comments. You are not actors, you are real people. A lot of people in this industry employ actors to give them testimonials. And unfortunately, because of that, now people think like Chris and whatever is an actor. Okay, Casper was an actor, but we didn't ask Casper for a testimonial, because a lot of fake guys will use testimonials saying, but I think you can work out they're fake anyway, especially in the States. Obviously, I don't have to pay people because, you know, you guys willingly gave them. Anyway, so I was left with 4,334 shares at zero cost. Of course, they took them out. And then I bought more at Whitewave when the spin-off happened. I made 200% on that. Danon offered a cash bid. Now, sometimes you get a share bid, so you end up with shares. Who was involved in the Baxter deal? Anybody in Baxter? Yeah? Okay. So what happened with Baxter? Baxter spun off Buxalta. What happened to Buxalta? Got taken over by Shire. And Shire gave some Shire shares and cash. Okay? So it didn't cost me anything. That trade was a zero cost. This is more recent, and again, you can search, put it in Google right now if you want to, buy Fiat Chrysler and get a free Ferrari. Of course, that was the hook. It's a free Ferrari share. So everybody that had a Fiat share got a free Ferrari share. All right? Fiat hasn't done very, very well, but we're still actually okay. So I remember a chart when you doesn't tell you the truth. So you see it drop 35%. You think, oh my God, my Fiat shares have gone down 35%. But you've got to look at the other side of the ledger, which is you've just got the Ferrari shares. All right? Ferrari at a new all-time high, by the way. So we pay $9 for Ferrari, right? For Fiat, sorry. Fiat are currently trading around 10. Let's say they're trading at 9. What did our race? Because race is the ticker. I personally think it should have been Enzo, but anyway, they chose race. And race are trading about $78, $79 if you roughly check at the moment. I wouldn't go out and buy them today, but considering they cost me zero, I've still got them. This all comes from FinViz. $1.50 to $2.50. $2.50 to $3, and CTV gone from $2 to $3. These are all small cap shares. Now, the majority of small cap shares do absolutely nothing. So this is, if you can imagine, this is what the majority of small cap shares are like. Now, if we invest in them, we might not lose much, but we're not going to make anything. But we will lose the spread, we lose the opportunity cost, we could have used the cash for something else. This is what we need. We need this red ball to touch this, which starts it off, okay? Which is called momentum. So Newton's first law of motion basically said if an object at rest stays at rest, you need something to get it moving. So let me tell you what happens in the penny share market. A penny stock is influenced by about 3 factors. Manipulation, okay? Chat rooms, stock promoters. If I'm a small cap company, I can pay somebody to start stories. Newsletters. If I tip a stock, if I gave you a stock on Monday and you guys all bought $1,000 at this level, we would be moving it by the afternoon. And no, we're not going to do it. PR, press releases, okay? A company obviously is trying to give out good news. Drug announcement, takeover, a large contract. So when a press release hits the market, that can have an effect. And also, of course, technical analysis, price patterns, momentum, just the price moving up. Well, these are the things that will move. Remember, we don't have the big boys in this market. The JP Morgans and all the rest of it are not in this market because it's not worth it. The majority of people in this market are fairly unsophisticated. I hate to say the word that he used, is like postman, but a lot of the people that are in there are people that are get rich quick. But there can be opportunities. There's also a fair amount of insider trading going on. All right? Now, you say, hold on a minute, Vince, isn't that illegal? Well, what they're doing is illegal. What you and I are doing is not illegal, okay? As long as you don't have any connection to that company. So say, for instance, an insider of a biotech company knows something is going to happen, and they buy stock and they tell their friends to buy the stock. What's going to happen? Who's the red ball? The insider. Who are we? We're here. So we weren't the insider. The insider got the ball moving. How do we know why are we interested in the stock? So when I've been involved in some of these stocks, and if somebody knocked on my door and said, you just made 100 grand out of a certain pharmaceutical company, and they'll say, how did you know there was going to be a drug announcement the next day? And the God's honest truth, I didn't. What I did know is that the price was moving. Yeah? So it's momentum. And we're identifying stocks that are already moving. Now, of course, we can also short sell. So when things hype up, we can also look to short them. But on the whole, we make our money from actually being long these stocks.
I hope you found this preview of value. Now it's time to take your trading and investing to the next level and learn as you earn with the full support of Vince Stanzione. You will have full access to him via email, and you will be able to see the same trades he is making. You can find out more at www.millionaire-trader.com. And if you have any questions, email him at vince@finbets.com.